When we look at an industrial facility, we see rust forming, roofs weathering, and machinery wearing down over time. A capitalized asset functions as an active measurement of future economic utility rather than a static historical record. Accountants track this utility through a metric called the carrying amount. This is the specific value at which an asset is presented on the balance sheet at any given moment. The rules for adjusting this amount are determined by the specific nature of the asset, whether it is classified as equity, property, or an intangible. Interrogating these three asset classes reveals how different accounting logic paths converge to create a single financial statement. Understanding these mechanical rules provides the necessary framework to identify the operational reality of a company. Equity investments require the equity method when a company holds between 20 and 50% of another entity's voting stock. This ownership level is presumed to grant significant influence over the investee's operations. While common stock confers this influence, preferred stock is usually non-voting and therefore does not factor into this calculation. Under this method, the investor recognizes its proportional share of the investee's earnings, which directly increases the investment's carrying amount on the parent's balance sheet. As shown here, Company P acquired 30% of XYZ on May 1st. Because they only held the investment for 8 months of year 3, they recognize a proportional share of earnings, $12,000, to increase the investment account. It is a common mistake to assume that receiving cash dividends from a subsidiary increases the investor's income. In reality, dividends are treated as a return of the investment. They decrease the carrying amount of the asset because the investee is effectively distributing its net assets back to the parent. This mathematical offset is visible in the year 4 data. While cash increases, we see a corresponding $6,000 reduction in the investment account balance. The equity method ensures the investment account acts as a direct reflection of the subsidiary's underlying net assets, rather than a simple, static stock purchase. When we shift to physical assets, or property, plant, and equipment, we have to distinguish between different types of ongoing spending. Costs that merely maintain an asset's normal service capacity are classified as revenue expenditures. These are recurring expenses that are recognized immediately on the income statement. Conversely, capital expenditures improve the asset's quality, extend its life, or increase its output. These costs are added to the asset's carrying amount and depreciated over future periods. To allocate these costs, accountants determine the depreciable base, which is the historical cost minus the estimated salvage value, the amount expected upon disposal. Land is a critical exception to this rule. Because it has an indefinite useful life, land is never depreciated. These definitions serve as a safeguard, preventing companies from artificially inflating their assets by hiding routine operational costs on the balance sheet. Matching the initial cost of an asset to the periods where it generates economic value requires a specific depreciation model. Straight-line depreciation is the most straightforward approach. It allocates an equal amount of cost to each period, as seen in this 5-year table where the expense remains constant. However, assets that are most productive when new often use accelerated methods, such as the double declining balance method. This method determines expense by multiplying the carrying amount at the beginning of the period by a constant rate. In year 1, we multiply the full $1 million cost by 40%, ignoring salvage value in the initial calculation. A hard stop occurs in year 5. Because an asset cannot be depreciated below its salvage value, the final expense is adjusted to hit the $100,000 floor. The units of output method ignores time entirely. It allocates cost based on actual production, meaning the depreciation expense fluctuates annually based on how much the asset is used. Each choice creates a different paper value over time, a steady diagonal for straight line, a steep curve for accelerated methods, and a jagged line for units of output. Selecting a method is a deliberate choice to align a company's financial reporting with an asset's actual utility profile. Intangible assets like patents and goodwill lack physical substance but still require rigorous valuation. Finite life intangibles are amortized over their useful life. Indefinite life assets, such as goodwill, are never amortized and are instead tested periodically for impairment. The valuation of these assets is often tied to legal defense. Successful litigation proves future economic benefit, while failure indicates the asset has lost value. Consequently, the costs of a successful legal defense are capitalized to the patent's cost and amortized. Costs from an unsuccessful suit are expensed as incurred. Goodwill is unique in that it is only recognized during a business combination, representing the excess of the purchase price over the fair value of identifiable net assets acquired. For an intangible, the carrying amount is frequently a measure of legal enforceability, as much as it is a measure of functional usage. These three assets illustrate the different adjustment mechanisms used in accounting: proportional income for equity, systematic decay for property, and amortization for intangibles. The carrying amount represents the current mathematical measurement of an asset's remaining economic potential. While the mathematical models vary, they all serve the same objective: ensuring the balance sheet accurately reflects a company's operational state. Interrogating the specific accounting method reveals the operational logic behind the reported cost.